Hey everyone, it's Imran. I'm back with another one of your macro option spotlights. Okay, US stocks treading water as we kind of await more news around the debt ceiling. We've got FOMC minutes as well this week and PCE inflation at the end of the week. So those are going to be your main macro data points. Europe has been a bit softer this morning on PMI data. There's the idea is the ECB is going to kind of be more hawkish there. And then China also rebounding from recent weakness. Japan's obviously been on fire, continues to do pretty well, up there near 31K, breaking through some major resistance levels on the upside. Looking at commodities, uranium was strong. Oil was well supported on OPEC. Saudi minister talking about warning the shorts, basically, saying that they could get hurt. Remember when they cut production unexpectedly, there was a massive short squeeze. Basically warning that could happen again. OPEC's due to announce something maybe next week, I think. And then metals also continuing to pull back, as did Nat Gas. Nat Gas was actually down 6% yesterday, but metals were softer as well. And then looking over at the dollar, grinding higher, along with bond yields, not at a violent pace, but still managing to stay in charge, basically king dollar. And then finally, in sectors, mostly flat-ish, except for ARC that exploded 5% higher, right up to that resistance area that we've been talking about, 40.5. So it's kind of sitting there poised. And the question now is whether or not it's going to really break that. If it breaks that, then, there's not a lot stopping this thing going 45 to 50 range, right? Pretty sharpish, which is another 10 to 20%. So look out for that break. Okay, in terms of skew, we did see skew come back a bit again. Obviously, there's quite a bit of noise in that right now. Even though spot was unchanged, we did see a bounce in skew around this kind of debt ceiling noise. We've got commodity and FX skew fairly unchanged yesterday. Treasury skew did flip back towards puts as treasuries continue to come lower, even though they're not doing it particularly quickly. They're just dripping lower. And then sector skew also flattening in general. The likes of ARC and XME skew down by half a vol to 3/4 of a vol. Okay, and then finally, implied vols and carry. Stock vol bouncing after the weekend slightly. Mixed moves in commodity vol with the likes of GDX, oil and nat gas lower, but uranium and copper higher. FX vols were also grinding higher as the dollar kind of holds its ground. Euro taking out 108 support levels. Bond vols were pretty muted, and then sector vols drifting lower, except for ARC, which was obviously supported by that big 2 sigma rally that we saw yesterday. In terms of carry, we are seeing more positive carry appearing in equities, getting deeper into the green. China's still the only one there in red. Commodity carry is more polarized, where you see some red, some green. And then FX mainly in neutral carry, suggesting that there's little risk premium priced into FX vols right now, where things are fairly well priced. Bonds and sectors, on the other hand, have got quite a bit of positive carry still, and you see a lot of green there on the bars for those two asset classes, with clearly XLV remaining that big one in 50% because that healthcare sector just doesn't want to move. Okay, so that's the summary for yesterday and what was going on. Now, looking at some of the charts, sentiment. So while sentiment around tech stocks, especially AI-related ones, has been reaching fever pitch, the same can't really be said for broader equity markets. Okay, so we know that this AAII bull bear indicator, if we look back at how that performed and if it had any sort of signal in it last year, you can see that whenever we made local highs in the S&P, they were met with quite a big swing up in the bull bear indicator. Okay, so bulls getting a bit more confident on those big sharp rallies. Now this time around, we have had a good rally in S&P, but look at what this indicator has been turning south. So there's a divergence between the sentiment indicator that would normally be going up with the market, and that doesn't seem to have happened this time around. It's still languishing and actually diverging from the S&P, even though the S&P is at local highs. So that's one divergence that we've seen in sentiment. Bank of America's got this sell side indicator as well. It's still closer to buy signal, which means extreme bearishness, which is bullish for stocks. And that has led their quant team to raise their S&P targets to like 4,300 and just shifting everything a bit higher. Now, the major reason that sentiment is diverging this way, we think, is the debt ceiling, the standoff. And so once that's resolved, we might see sentiment improve, and markets can then, if markets rally into the summer, you might then see this big catch up in sentiment for us to then feel that a material move down is more possible, right? Because at the moment, you know, where we do see room for corrective price action over the next couple of weeks as we approach D-Day maybe, right? We do think this sentiment picture makes it quite difficult for sell-offs to persist for very long, because you will get short covering, which will support markets on the way down because people just don't own this market. So they're going to be looking for these pullbacks to then get some exposure back, right? So that's what's going to really prevent. And there's a fair amount of hedging, obviously, because skew has got more elevated. So all these factors kind of make it hard for the market to have really material sort of stingy moves to the downside. Okay. What else are we looking at? So we mentioned the AI optimism that's been going around. Yesterday's note, we said NVIDIA earnings, it's been the darling of the AI sector. Those earnings are due Wednesday after the close. You can see the stock has obviously just gone absolutely parabolic. You know, it's also compared to all the other sort of names that you might look at in the tech space, like Google, Microsoft, the semiconductors index, the NASDAQ, all of these things. I mean, Google and Microsoft are big in the AI space. They've done 30% since February. NVIDIA's done double that, right? It's done 60%. Okay. So it does seem like there is a bit too much hype in this. You know, consensus around AI being the biggest growth story since the internet. You know, we kind of feel that on how is this stock going to beat earnings expectations, right? Even if it beats analyst earnings expectations, the true whisper for this stock is miles higher, right? Everyone's piled into it. Everyone's getting excited about AI, and this is the no-brainer stock to own because everyone needs their chips, right? So we find it pretty tough. Like the bar that this stock needs to beat to create a significant rally on earnings, we think has to be pretty damn high. Whereas if they don't come out with stellar and amazing earnings and amazing guidance, then surely there needs to be a bit of a pullback here. That's what we're thinking. So we just think it's got a lot of asymmetric risk right here, right now. We struggle to see how there's too much of a wild move to the upside, given how much this thing's run up and that everyone's kind of got excited about this whole space for the last month or two. So we're looking for ways to leverage a pullback rather than the continuation of the rally. Thanks a lot, everyone. I'll catch you all next time.